welcome to Accounting is Awesome. My name is Diane Hammond, and I'm going to be guiding you through the journal entries that we are going to be preparing for this particular scenario. Here we have Hammond Company purchased merchandise on account, so that means they charged it, from Zelda's Incorporated for $80,000. Terms of the sale were 2% can be discounted if paid within 10 days, otherwise the net is due in 30. Prepare the journal entry to record the sale on Zelda's books using the gross method. The cost of the goods sold is $71,000. So for this transaction, we are going to be considering Zelda's side. Zelda is the seller in this case. There is a separate video that reviews the Hammond side of the transaction, or the purchase side of the transaction, also using the gross method. So be sure to look for that video as well so you can understand how both sides work. So for this journal entry, again, we're looking at the gross method. So even though we're given the terms of the sale, we are not recording the discount yet. We're going to, in this case, assume the full amount. So accounts receivable for Hammond Company is going to be debited for $80,000. Sales revenue will also be debited, or will also be credited, for $80,000. Now remember, when we're talking about the sales side of the transaction, this triggers two transactions, or two journal entries that must be made. We must also record the cost of the goods being sold, which were given as $71,000. That means that's also going to decrease the amount in the inventory account. So we will credit the merchandise inventory account for that same $71,000. Now let's look at number 2. Prepare the journal entry to record receipt of the payment, assuming that Hammond Company pays Zelda within the discount period. So you'll recall that 2% was allowed to be deducted if paid within the 10-day period. Over on the right-hand side, you'll see that I've got this calculated for you. $80,000 times 2% would be $1,600. This is the amount of the discount allowed. Subtract that from the $80,000, and we'll see that the amount due should be $78,400. Or, that's doing it in the 2-step. You can do it in the 1-step by taking 100%, subtract that 2%, which is allowed. That means 98% is what should be paid. And then when you multiply 80% times 98%, you get $78,400. So the same exact amount. It's just doing it in 1-step or 2-step, and whichever way you are most comfortable. I encourage you to begin doing it with 1-step. So how are we going to put those numbers into the recording here for the journal entry? We are going to debit cash, because this is the amount of the check that we will have received, probably in the mail or maybe an electronic transfer, $78,400. The amount of the discount was $1,600. We're going to label that as sales discount. So when you prepare your income statement for a merchandising company, you will have your revenue, and then you will have, if you have allowances and returns, you'll have that listed, returns and allowances, as a subtraction, and then you will also have sales discounts listed as a subtraction, which will get you to your net sales revenue. The amount of the accounts receivable for Hammond Company should be the full amount of $80,000. That's the amount that we originally billed them for. However, we allowed this discount, so they are satisfying this debt in full. The next entry, entry number 3, is more of a what if. So we are to prepare the journal entry to record receipt of payment, assuming now that Hammond Company does not pay within the discount period. So in this case, the check should be for the full $80,000, and the amount of the that we will credit, let me take that off, the amount that we will credit for Hammond Company is the same $80,000. So debit cash, $80,000, credit accounts receivable, Hammond Company, $80,000. Number 4, merchandise which is sold for $10,000 is returned prior to payment, and the cost of the merchandise is $7,500. So that's the cost of the goods sold, $7,500. And this is, we're staying with the same, Zelda is selling to Hammond Company. For whatever reason, $10,000 of those goods are being returned. This is going to trigger 2 of the journal entries as well. So we're going to have the, let me correct that. Not sure what that T's doing there. Sales returns and allowances. We're going to debit that account for $10,000, and we're going to credit Hammond Company for that same $10,000. Now we need to also record that the merchandise is coming back into the warehouse. So the amount of cost that we have on that merchandise is $7,500, and so the cost of the goods sold will be reduced with a credit to that account for $7,500 as well. So debit the merchandise inventory $7,500 and credit cost of the goods sold for $7,500, and that's for this return that is being made. The next transaction, number 5, I wanted to leave number 4 on the screen so you could compare the difference here. Here, the company, Hammond Company, is given an $800 allowance to keep damaged merchandise prior to payment. So perhaps this merchandise was just damaged a little and they could still use it, and because Zelda does not want this merchandise back, no one wants to pay the shipping and handling charges to ship this merchandise back and forth. So instead, perhaps Zelda would say, let me just give you an $800 allowance, similar to a discount. Just let me deduct that from the amount you owe me and you keep these goods. So in that case, we're going to have sales returns and allowances is going to be debited for $800, and Hammond Company's account receivable is going to be credited for that same $800. Notice the difference is that Hammond is going to keep the merchandise, so we don't have to record that the merchandise is coming back to inventory, and it doesn't affect our cost of the goods sold account. Now let's look at number 6. Hammond paid the invoice with an $800 allowance by the discount date. Remember, they also had this $10,000 in goods that were returned. So they had $10,000 returned, they received an $800 allowance, and they are paying by the discount date, and so that allowed them to take 2% of what they owed. So I have those calculations over on the side, and here they are. $80,000 minus the $10,000 plus the $800 would be $10,800, leaves a balance, a gross amount of $69,200. They are going to be paying 98%, so that's 100% minus 2%. 98% of that amount would be $67,816. When you subtract that from the gross amount of $69,200 after the return and allowance, you see that they're getting a discount of $1,384. Now let's see how to prepare that journal entry. And here it is on the Zelda books. So they're going to receive a check in the mail or money, a cash transfer of some sort, $67,816. They're going to recognize a sales discount for $1,384, and then they are going to credit the Hammond account receivable for $69,200. Other topic here I'd like to go over with you. Other issues are things like freight charges, who's going to pay them, and how the goods are shipped when the ownership changes is very important, because that determines whose insurance company is going to be liable in case there's an accident, that sort of thing. So FOB stands for free on board. We have free on board or FOB shipping point, in which the buyer pays the shipping charges, and we have FOB destination, in which the seller pays the charges. For this video, I've chosen the transportation FOB to be destination, which is the seller. Zelda is going to be paying the shipping charges, which are $500 in this case. So for the seller, the way that they will recognize that is to debit a delivery or shipping expense account for the $500, and they will credit the cash account for $500. Notice this is different from the purchaser. When the purchaser pays the shipping costs, they actually add the cost into the value of the inventory, so it becomes a part of the cost of inventory. Okay, that concludes this video. Be sure to like any of them that you find helpful, and